All right, so I love what Catherine said. Her husband and she saw Elton's farewell concert in LA a couple of years ago, and it was really, really great. Yeah, and he was on the Strip, Evan, in Vegas for a long time. Cool,
Are you trading?
I'm not trading you right now, baby. I'm doing my class. Who knows who did the harmonica solo?
Was it Stevie Wonder?
Stevie Wonder did the harmonica solo. And as I understand it, he did that wonderful harmonica solo on one take. Dude just comes in and just did it, one take, and was done. That's music there. So, I mean, let's just look at the lyrics just for a second. I mean, don't wish it away. Don't look at it like it's forever. Between you and me, I can honestly say that things will only get better. And while I'm away, dust out the demons inside, and it won't be long before you and me run to the place in our hearts where we hide. I love, how can it get any better than this? Rolling like thunder under the covers. And I guess that's why they call it the blues. And then, of course, we do see the line that Bernie said he wished he had not written. I simply love you more than I love life itself. And I think that's, you know, what by Bernie saying that, I think it's important to realize that it's okay to love, but we shouldn't, you know, I mean, we have great love for people, but it's not a healthy thing to not love yourself. I think that's kind of what he's trying to tell us here. To love someone more than you love life itself means that if that person was not in your life, then you don't want to live. And I think that's where his regret came from on that song. Anyone got anything to say about the song at all? Y'all like it? Surely all of you have heard it before, right? It's not the first time that this is brought up to anybody. All right, excellent. No further comment about Elton. All right, so a lot of you have put in your very first trade. How'd that feel? Catherine, how'd that feel? You've done it, right?
No, I actually have not done it.
Okay, Catherine hadn't done it. Who's done it that would like to talk to me about it? Hey, Brad.
Yeah,
Oh, go ahead, Kyle.
Oh, that's my first trade with paper money. What's scary is it's one little clip and it's a lot of imaginary money. So it's very easy I can't imagine if you just, bought 20 of them or 100 of them, it's the same one little click.
Yeah, one little click, right? A monkey could do it. And that's what Tom Sosnoff, they had a little thing back in the day where they gave away little monkeys to people that, were think or swim users, because they said, hit it, monkey, hit the button, right? So a monkey could hit the button. It's so easy. So they made the monkeys up, but they didn't realize how the three words look together. So if you have something that you had on a little monkey's t-shirt and it looked like this, look what, where's my thingy majig? Here's what it looked like, y'all. So people were saying, why would they say high tit monkey? And so instead of hit it monkey, they were saying high tit monkey. And so it kind of, I wish I could find one of those. I'd love to have a little monkey on my desk that says hit it monkey. So yeah, it's easy to make a trade. Now, one of the things that I want y'all to realize, some of you need to change your contract size to one contract rather than 10. Okay. So
I noticed.
Yeah. So some of you,
yeah. I noticed that it did, even though I put it at 1, when I hit send, it reverted back to 10 anyway. So I went back and canceled it and did it again.
Yeah. So did anybody have trouble getting filled? Anybody have trouble, or your order went through, it filled? See, some of y'all are overseas and watch this when the markets are closed. And so you were not able to actually execute the trade live. So, you're not in that position. But for the remainder of you who are in the position, how does it feel? Are you watching your position? Are you looking to see if you're profitable? Tell me about the experience. I kind of like to know.
Sir, this is Shauna. So my main issue is I know that you sent it back saying that I sold instead of bought. Could you just like show us again? Because I guess I got confused on when I went in because I hit the bid and I mean I hit the ask and that's or which way. So I think I'm getting them confused still.
Yeah, Shauna, I'll show you, absolutely. And look, when I gave you like half credit, don't think I was an a-hole, okay? Because I clearly said, you know, I want you to be able to go back in to do it correct. And I hope that's what y'all will learn about me. I'm not here to punish y'all. I'm not here to do anything but enlighten your mind, challenge your mind, inspire you, and encourage you. So anytime I give you that feedback, y'all don't think, oh, what a jerk he is. He give me 50%. And the only reason I'm doing it is to market for me to know that, you know, you're going to redo that. But yes, I will show you exactly. And a couple of people actually did that. You hit the ask rather than the bid. So we'll go through that. How is your positions doing? Those of you, are you watching it? Are you up money? Are you down money? Someone tell me how you're doing. How much money have you made?
I know that I'm not watching mine because I've
Okay.
learned from experience not to watch it like a hawk. As the old saying goes, a watch pot never boils.
Exactly. That's good, right? So you put your trade on, and that's what we kind of like to do. And you'll figure out that the more that you and I tinker with stuff, the more difficult we make it, the more fees we will spend, and the less successful that we will be. So this is one trade in a overall comprehensive strategy that you should be helping to put together for long-term investing. And I just wanted you to know how powerful it is to sell a put to acquire stock at a cheaper cost basis. So everybody make sure you know what cost basis is, right? So if you buy 100 shares at 100, your cost basis is 100, right? If you bought 100 shares at $100, your cost basis is 100. So then if you buy another 100 shares and the price goes down to 50, right? So you've got 100 shares at 100, you got 100 shares at 50. Your what is your oh my gosh, I'm having a brain fart. What is your cost basis? Yeah, cost basis. Anybody know?
I mean, your cost basis is basically how much you paid for it when you bought it.
Right, but we're trying to reduce cost basis. So you want your cost basis to go down. So the cost basis of this 100 shares is 100. The cost basis of this 100 shares is 50. So now you have 200 shares, but what is your overall cost basis?
Oh, it's the average between them, wouldn't it?
Yeah, the
Wouldn't
average.
the average share would be $75.
Yeah, so $75. Now everybody sees, because, and I think a couple of you were like, hey, Bob, you went over a lot of stuff, a lot of terminology that's kind of jargon to me, and I forget that sometimes. So it's my apology. So I want to make sure you know what cost basis is. So what we're trying to do is to reduce cost basis. Now, we've got the $1 billion man coming to talk to us in, probably the end of February. I'm going to offer Tom a couple of dates so he can speak to us. But I've often heard Tom Sosnoff, who invented the Thinkorswim platform and the Tasty Works platform, what he said is this: if you're interviewing a financial planner, you should ask them this question. And if they can't answer this question, you do not need to hire that financial planner. And the question is this: okay, I understand all this great stuff that you're going to do for me. Here's the question. Ready? How are you going to improve my cost basis? Now, can you imagine what would happen if you asked 99.9% of money managers what they would do to decrease and improve your cost basis? What do you think they would say?
Most of them would say that they're going to use dollar cost averaging, and that will give them the lowest price per share is what the common answers in the industry.
Brad, I think you're giving them too much credit. I don't think they know what the hell you were talking about. I really don't. I think, they would go, I don't think they know. So dollar cost average, so what we're trying to do is to improve upon our basis and with options, give you options to where theoretically, and people have done it, you could improve your cost basis to a point that you would acquire the overall amount of shares for theoretically for free. But you're trying to lower your cost basis to get into them for a better price than you theoretically could have. So if a stock is currently at 100 and you can sell a put to get in it at $90, then you've improved your cost basis by $10 a share. Been in at $90 rather than 100. So I just want to make sure everybody understands kind of what cost basis is. Over a series of purchases and sales, your cost basis will change, but the goal for you in your investment program is to improve upon your cost basis. Make sure that you're acquiring shares at lower prices and helping your cost basis out. That's what the Lucello book, and we haven't talked about it yet. Some of you haven't got the book yet. Some of you are a little bit behind. I warn you, please get to that reading. Make sure you're in that reading because it's going to become a huge part of what we're going to talk about. So cost basis. Any questions on cost basis whatsoever? I want to make sure y'all are good. Yeah, Dr. Brent, 75. Got it there. All right. So a couple of other things that I just rambled on last time because I wasn't on my Adderall and my Venflaxin is I was talking about bullish and bearish, right? Now, I didn't even explain it to you because a lot of times I just assume that people know this, but I don't want to make any assumptions. All right, someone tell me what bullish is. If I am bullish on Apple, what does that mean?
You think the price is going to go up?
Extra point to Zach. Email me, Zach, you get an extra point. I think the price of the underlying asset is going to go up. So I am bullish on that asset, whether that asset be gold, whether it be oil, whether it be wheat, whether it be pork bellies, anything, right? I'm bullish on it. So anytime I say, hey, the bulls are in control of the market, that means the ones who are driving the asset prices up, who believe in the appreciation, whether short-term or long-term, on the price of that asset, okay? And that brings us to bearish. So what does bearish mean? Someone give me the bearish thing. You know what that is?
Goes down.
Catherine, did you say that? Yeah, go ahead.
I was just saying that you believe that the prices are going to go down.
Yeah, so if I tell you that I'm bearish on bonds, then that means I believe that the underlying price of bonds is going to go down. If I say that I'm bearish on gold, I think gold's going to go down, or if I'm bearish on the stock market, I believe that it's going to go down. Now, here's something that I bet some of you have never thought about in your entire life. And can you believe that I didn't know this until just a couple of years ago? Because you never really think about why sports teams have their names. Okay, someone tell me the name of the Chicago basketball team.
Bulls.
The Bulls. Someone tell me the name of the Chicago football team.
The Bears.
The Bears.
Someone tell me the Bulls and the Bears. I never knew that. I never knew that. Hey, wait a minute. The reason they're the Bulls is because Chicago is where a lot of commerce is traded, right? So that's where a lot of the options markets are, right? Where the people were on the pit of the floor trading these options, and we've got Bulls and Bears. And even it goes to one of the baseball teams. One of the baseball teams is called the
Cubs.
Cubs. Well, what is a cub? It's a baby bear. So everybody sees, I mean, in the great state of Illinois, you got the Cubs, you got the Bears, you got the Bulls. All of these revolve around the markets. So start thinking about bulls. I mean, if I'm bullish on something, I want something to go up. If I'm bearish on something, I want something to go down. All right, let's now break that a little bit farther. What if I tell you that I am long gold? Make sure we got all the jargon down. Hey, my little redhead's asking something. Let me see what she said. What, baby?
Are you gonna buy us crayons?
After a while, okay? Go, baby. She wants crayons. All right, so if I'm long gold, what does that mean?
That means you believe the price is going to go up long term.
So if I'm long gold, I tell you that my position is long gold, that means I'm holding the asset, or I am in a position that desires for the gold to be going up in price. So I'm bullish. If I am long gold, you can believe that I've probably either bought futures, gold futures, or I have sold some puts or bought some calls in gold. I have a position. I am long gold. I am long it, which means I want it to increase. So if I am short something, it's just the opposite, right? These things are just the opposite. So if I'm short stocks, that means that I have positions that will benefit if stocks go down. If I am short gold, I have positions that will benefit if gold goes down. Because that's what a lot of people don't realize. See, most people think if I buy a stock, you know, what are you? You are long Apple. Right? If I own Apple, I'm long Apple if I have Apple shares. Now, interestingly enough, what stock did you guys in your discussion say, if you had one stock to buy, most of you said which stock? Y'all know what it is. I just put it on the board. Apple.
Apple.
Now, the contrarian in me made me want to short Apple. The contrarian in me goes, what the hell? All of y'all are so long on Apple, and all they do is come out with a new size phone with a different color and a better camera. And y'all are all bullish on it. And that made me instantly think, I need to short Apple. Isn't that funny? And that's called being a contrarian. Contrarian. Right? So knowing that the crowd is going one way makes me want to go the other way, because I don't like following the crowd. And if the crowd, if Joe Q Public is bullish on something, then that's the time that I need to pull the plug on something and be a contrarian. Okay? Questions on that? I just want to make sure you know. So if I say, hey, let's short this, or let's short that, or I'm long something, you got to understand what those words and what those terminology means. Now,
Quick question, Bobby.
yeah.
So are call and put sellers both short?
Okay, let's see. They have short positions, but they're not necessarily short the underlying.
That's where I'm getting confused, because I know a call writer is bearish and a put writer is bullish, but I'm getting confused with long position and whether they're long or short on the asset.
Sure, let's go through that a little bit, because I think that's good, Zach, that we kind of do that. So let's talk about puts. And let's talk about calls. So we want to make sure you know how to get bullish or bearish with an underline. So if you buy a put, Zach, are you bullish or are you bearish?
You're bearish and you're hoping that the market goes down.
Exactly.
So that the market is less than the strike.
So if you buy a put, you are bearish, right? If you buy a call, it's just the opposite, right? If you buy a call, you are bullish. Now, so let's go over to the sell. Make sure everybody gets this. If you are selling a put, you are bullish. And if you sell a call, you are bearish. Y'all might want to take a screenshot of that or draw it on your paper or whatever. I just want to make sure that you kind of get a feel. So if you're buying puts, you're bearish. If you're selling puts, you're bullish. If you're buying calls, you're bullish. If you're selling calls, you're bearish. Now, when is the optimum time to do each one of these things? Now, this is where it's going to blow your mind. So you all went into your program and you sold a put, just like I told you to do. Is it better to sell a put on a down day, or is it when the market or the underlying asset is down, or is it better to sell a put on an up day?
And okay, so that it has some room to go down.
Okay, hold on one second. Jack, let me hear what Jack had to say. Jack?
I was saying it's better to sell on an up day so the market can go down, right?
Okay, so it's kind of the opposite of what you would think. It's better to sell a put on a down day. Let's look at it as a balloon. You've got a balloon right here that has not been blown up. It's just a flat balloon. So what happens is when the market goes down, the price of the puts increase. They blow up like a balloon. So a put that yesterday, when the market was up, the strike you may could have sold it for $1, right? Bringing in $100 because it's $1 per share, and a single contract represents 100 shares. So if you sell it for $1, you bring in a credit of $100. But on a day when the market is down significantly, you could sell that same strike for $3 and bring in premium. Premium is the credit that you receive. The money that you receive is called the premium. We'll talk about premium a lot. It's just like insurance, right? So you're selling a put. If the market goes down significantly, it blows the value of that option up. It's like a big old puff of air comes in. And what you may have been able to sell yesterday for $1, you could sell for $3. And we're just throwing out hypothetical numbers. Why? Does anybody know why?
Because now you have a greater opportunity for that stock to go up in the future. So it's going to be at a premium.
Well, everything in the markets, Brad, has to do with how many of you have taken your economics classes? I know you have. What's the big thing in economics? Supply and demand, baby. Right? Supply and demand. So when the market goes down, Joe Q Public is doing what with puts? He's scared. He's trying to protect his assets. So Joe Q Public is buying puts. Everybody got it? Because he's like, oh, I got to protect my assets. I can buy a put because when I buy a put, that's bearish and that makes money if the markets go down. So that's what Joe Q Public does that knows about options. So if his increased demand for puts is out there, you and I can come in and meet the demand. So as increased demand comes into the market for puts, you and I can meet the demand by selling a derivative that we don't even own. So you always see in investing, what should we do? We should buy low and sell high. But there are times that we do it exactly backwards. We sell high and buy low. And that's something that options allow us to do. So you've always heard buy low, sell high. But with a put, you sell them when they are high, when that balloon has been bumped up, okay? That's when you sell them. And then you buy them back when it's lower. So let's say this. Let's say that you sold your first put the other day. You sold that put. And let's say that you sold it for $1. All right, Lisa Benton, how much money did you receive from selling one single put at $1? What was the premium received? The credit received? Lisa, can you hear me? How about Christy? Christy Pay. And y'all
Sorry,
can.
I had to mute myself.
That's okay. Yeah, and all you got to do to unmute yourself, just hit the space bar and hold it down. That's the quickest way to do it. Yeah. So you sell an option, a put for $1. How much money do you bring into your little business here?
Is it not 100?
Yeah, $100, right? So you're so happy you sold it today for $1. Now, I want you to look at the options that you guys sold. Are you up or down money today? If you are down money, I can probably tell you what has happened to the price of the underlying, and you'll hear me use this word, the underlying, and sometimes I'll use this as a noun, your underlying. What is the underlying? You sell a put in SPY, what's the underlying? The underlying is SPY. You sell a put in Apple, what's the underlying? The underlying asset is Apple. So if you're down money on your put today, there's a reason. Because that put that you sold for $1 yesterday may be worth $2 today. And if you had to close it today, remember you sold a put, how would you close it? Well, you'd have to buy the put back. And the put that you sold yesterday for $1, you're having to buy back for $2. So you're having to pay $200 to close the position if you wanted to close it today for a loss of $100. Everybody with me? That's why what happened, the market movement was down, and the market movement caused that balloon that you sold for $1 to swell up to $2. And if the market continues to go down, guess what? It could go to 3 or 4 or 5 or 10 or 12. And then you could have an enormous loss on selling that put. But I don't want to go into how loss, how risky, all of those things. Now, I just want you to kind of know the directional impact of market movements on what you're doing. Now, if you had bought that put for $1 and the market goes down, you're excited because you bought it for $1. And if you want to close it, maybe you sell it for $3. So you end up making $2 a share times 100 is $200. Just want to make sure everybody gets that. So the best time to sell a put is when the underlying asset is down. And it would be just the opposite if you're buying a put. The best time to buy a put, no, I'm sorry, let's say, sorry. If you're selling a put, you want to sell a put when the market is down. It's a bullish position, but it's more ideal to do it when the market is down. Buying a put, which means you hope that the market goes down, is just the opposite. The best time to buy one is when the market is up. Wagga, 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 wagga. Shake the cobwebs out, right? It's just kind of the opposite of what you think. Now, and the cool thing is Joe Q Public is doing the dumb thing. They're buying puts when the market is down. No. You buy them when it's up. When do you sell them? When the market's up? No, you sell them when the market's down. There's an inverse relationship with calls. The best time to sell a call, right? Here we are selling a call. That means you're bearish on the market. But the best time to sell a call is when the market is up. Because the price is getting closer to the strike that you're selling, and that strike is going for more today than it was yesterday. Best time to sell calls is on up days. The best time to buy a call is just the opposite. Now, buying a call is bullish, but the best time to buy a call is on a down day. And it's one of those things that sounds a little complicated, but I promise you, the more that we do it, the more comfortable you're going to get. You're really going to get comfortable with it. You'll know all this. Trust me, you're going to be fine. All right. Now, let's go to the Tastyworks platform. Oh, by the way, I spoke to Thinkorswim, I call them about every 6 months and say, will you reduce my commissions, please? And then I'll tell them how poor I am and how I got 5 kids and blah, blah, blah. And so, pretty much today they said, screw you, dude. No, no. And they like, you've got a great commission rate. So every 6 months or so, I'll give them a call and I try to beat them down. Sometimes I'm successful, sometimes I'm not. I give them this pity story, blah, blah, blah. But I did ask them while I was on the phone with them, how do we keep your paper accounts from expiring in 60 days? And it's really quite simple. You need to open a real account. Now, here's what I want you to do. You don't have to fund your real account. So you don't have to put money in your real account. Or if you wanted to put $1 in to open it. And as long as you're opening a real account, it'll connect with your password and everything. And you can say, hey, I'm in a money account, or it's in your paper account. So if you want to keep it going, open a real account. They said you don't have to fund it. You just got to open it. Okay, questions about that? Now, also, I'm going to show you somewhere else. Now, remember, Tom Sosnoff is coming to talk to us. He came up with the thing. So his new invention is this. And I like this brokerage as well, right? This is a great brokerage. And I wanted to just show y'all because I like this. There's things I like about Tastyworks that I don't like about Thinkorswim, and there's things about Thinkorswim that I like that I don't like about Tastyworks. So I use both, right? I use 2 different brokers for different things. So I like this because you're going to like the graphics much better. You can do the graphics in Thinkorswim, but it's not as good. So you can go to Tastyworks and you can open an account at Tastyworks. I would encourage you to do it, tastyworks.com. And what would you do then? You don't have to fund it. You just got to open it. Unfortunately, they don't have a paper trading account, but I think you're going to like it because the analysis that you and I do is going to be really, really good. So let's put in the asset SPY. All right, SPY. What is the probability if I buy stock that the price of SPY is going to go up and the price of SPY is going to go down? Lisa, Urena. Lisa. What's the probabilities? Because remember, we're quants. You and we don't hang our hats on fundamental analysis too much. We don't put our hats on technical analysis too much. I mean, they're fine for some people. I'm just trying to keep you from going down those holes. I'm trying to say quantitative analysis is where it's at. That's where the smart money's at. So if we are buying a stock or an ETF and we're buying the S&P 500, what is the probability that it goes up or the probability that it goes down?
100%.
100%. Well, it's got to go one way or the other. So let's say tomorrow you wake up, you buy it today, you buy shares of SPY today. What's the probability that tomorrow it goes up? And then tell me what the probability is that it goes down.
50-50.
Yeah, it's roughly 50-50. Now, because there are positive drifts in the market and overall stock market go up, you may say that it's 51.49 that it's going to go up, or it's 53.47. All right, everybody with me? But really, it's a coin toss. You toss the coin up. We don't know if it's going up or down tomorrow. Nobody knows if it's going up or down tomorrow. So watch this. Now, we're picking up at Dr. Brand. If I'm going to buy, do I click on the bid or the ask if I'm going to buy? And I hope y'all don't mind me asking y'all questions because there's no wrong answers, and I'm not here to embarrass anybody or to get the wrong answer. We're just family here, right? Y'all are comfortable sitting back, we're stress-free. But Dr. Brent, if I want to buy 100 shares of SPY, do I click on the bid or the ask?
Let's see. I think if you want to buy, you get the screw job, so you have to pick the higher price, which is the ask.
That's exactly right. Because if I'm buying it, I want to pay a lower price, but dang it, they're going to make me pay the higher price, right? So whatever it is that screws you is the one that, I don't know of any other terminology to tell you. So we're going to click on the ask. So I'm going to left click on the ask. Okay, so here we go. So here I am. It says that I am buying 100 shares at a limit price, never use market orders. Never, ever ever use a market order. Why? Anybody know?
Because the price can go, if you're buying, the price can go up dramatically.
Yes, Christiana, and guess when it does it? At the most inopportune time. And so the market makers see, Joe Blow public out there doing market orders, and they're go, well, let's screw Joe Blow. Let's make him pay more than he should be paying. Never do a market order. Never, ever, 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 ever do a market order. They're always limit orders. And if you have to, go in and cancel and replace your order and bump it up, but never put in a market order. So by default, everything's a limit order, okay? Very good. Christiana, send me an email. You get an extra point. That was excellent, excellent, excellent. So now watch this. The probability of profit is 50%. Isn't that what we talked about? 50%. We really don't look at the probability of getting 50% profit. That's what that is 50%. We really don't look at that on stock. You're getting 100 delta. Remember, delta, we're going to talk about a lot. You're going to learn all about the Greeks, but delta in this situation is telling us about the directional movement of the stock. So you have positive 100 deltas because you have positive 100 shares. That means you are bullish 100 deltas. You're buying 100 stocks, so you get 100 deltas. Don't let that worry about you. Your maximum profit is infinity. For those of you who have kids, y'all know about the Buzz Lightyear, to infinity and beyond. If this goes up to 1 million and you own 100 shares, your maximum profit never ends. Your maximum loss is the price of the stock or underlying that you're buying times 100, right? Because it goes to 0. So your maximum loss is 43,221. And it says that it's going to cost me $21,000 in buying power to do that. Well, it's because this account does not have the buying power to do it. But I want you to watch this now. So the probability of profit is 50%. Now watch this. Let's see if I can get this to work. I'm going to go to the curve and I'm going to go to analysis. And I want you to see exactly what I want you to see. Here is this beautiful little diagram. Green, what do y'all think green means?
In the money.
You're making profit. Red means you're making loss. So you have a 50-50 shot. This is called a risk graph or a risk profile of the order that you're about to send. Everybody see that? And all I did is I put it on the curve and I put it on analysis. So now you've got a 50%. So it tells you, you follow these little prices along, right? So if you're buying it at 432 and you're buying shares and it goes up here to 485, then you have made $5,231. If it goes to 495, just move your thing over and follow these little numbers up here. Then you have made $6,339. 505, you made, $7,244. And the same thing when it goes down. Just look up here, right, over to the right, and move it down, and you can see how much money you lost. So if it goes down to 355, you've lost roughly $7,707. Questions on that? Isn't that cool? So does everybody understand what you're seeing here? This is just the risk profile. If the stock goes up, you make money. Stock goes down, you lose money. And it's a 50-50 shot. I don't know about y'all, but I don't like those odds. I don't like the odds that, hey, it's 50% that it goes up and it's 50% that it goes down. And that's where the options come into this. Y'all, if I was Pentecostal, I'd be speaking in tongues right now. I'm so excited because this is something I wish I had learned when I was in investments class, and they never showed us this stuff. I feel so glad that y'all are getting this. Not that I'm, the ideal teacher. It's just that I've been through this, and this is the stuff they didn't teach me in college. And here you are in an investments class, and you're getting this. I feel great for that. All right, so what's this? Now let's go do your options. So I'm gonna clear the order.
Can I ask a quick question?
Absolutely, Brad.
Two things back on that last screen. You had said about don't do a market order, do a limit order. I think you said, where was that? I did not see where you were clicking. Second thing, is down at the bottom, you had 100. Now you're buying one lot of shares compared to on the other one, Thinkorswim. I think we clicked number 1 and it was automatically 100 shares. Is that the difference between the two platforms?
Yeah, so keep in mind that this is stock. What I wanted y'all to do with the options were to do one contract of options. So one contract of options controls 100 shares of the underlying stock. That make sense? Okay.
Yep. I just wanted to make sure I was understanding.
And then, you know, if you don't want to buy 100, I mean, you could simply go here and go, only buy 2 shares, right? And you know, just, you know, I'm going to put in 2 shares. So you can change that quantity at any time that you like. Hold on a second. My little son's wants, oh, you brought my spam hat. Thank you, son. He's the sweetest little thing. Oh, sorry, take this one off. Sorry. I lose them all the time. So that bitch. Okay, so I got my spam hat. All right, so watch this. So you've got this risk graph. Watch this now. Watch why I like options so much. Y'all are going to love this. Oh, I'm all about this. I'm going to hit the clear button. Then I'm going to bring up the trade button and I'm going to bring up the table. Now, remember, we've got, this is the option chain, right? So you could sell options that expire tomorrow. You could do them 4 days. All this is the DTE, right? The DTA, days to expiration. So where I like selling options, and we'll talk about theta decay, we'll talk about premium. I don't want to give you too much all at once, but I basically want you to know that I go out to about 50 to 60 days on this. So I'd probably go out to 50 days. Okay, I want plenty of time for my position to work. So I'll go over here and I'll left click and it brings up the options chain. Here's where the current, you see the little line in the sand, right? This is where price is trading on SPY. It's at 431.84, so it's right here. So here you have puts and here you have calls. And you can sell puts that are in the money, or you can sell puts that are out of the money. So let me draw that on you. So what does in the money or out of the money means? Well, it means basically, is it above or below the current strike of the stock? So these puts, the 432, 433, 434, 435, 436, these are called in the money puts. These are in the money. So if you go over and buy or sell these puts, they're already in the money. It's already, you know, over here. So these are out of the money put. So if I tell you, I want you to sell an out of the money put, that means that the put is below, the strike price of the put is below the current price of the stock. And it's just the opposite over here, right? This is in the money calls. Every strike going this way are in the money. And the strikes going this way are above the current price of the stock. So we would call these out of the money calls. And that's just saying, what is its relationship to the current price of the stock? So it's out of the money calls, in the money calls, out of the money puts, in the money puts. What do you call one that's right here at the line? We call those at the money. They're at the money. So if the price of this is 431, then we would say the 431 is at the money. We would probably even say the 432 is at the money. Split the baby. So if I'm saying selling at the money put, that means you're selling a strike or buying a strike that is right at the current price of the stock. Everybody with me on that? Catherine, I run Catherine off. Catherine, you okay?
My dog wanted to go out. Sorry.
I thought I offended you. We're supposed to go get some other dog today. Oh my God, we don't need dogs. I got 2 Great Pyrenees outside. I've got a Yorkie poo that someone gave away on Facebook. Best Luck. Can you believe they gave this dog away? Yeah, after it had to have $2,000 in surgery to get the plastic and the glass and all the crap out of its belly. Yeah, I could believe it. And then they call me, the vet calls me, Mr. Gaines, I'm sorry to tell you, but it's worse than we thought. You want me to just go ahead? It'd probably several more $100. What am I going to do? tell them to close him up, let him kill the little thing? No. So, you know, and it still eats plastic and glass and all kinds of crap. Anyway, so we're supposed to get another dog today. Beth, what's that dog we're going to get? Well, but what kind is it? A guard doodle. What?
Golden
Oh, a golden doodle. I don't need a golden doodle. Unbelievable. Anyway, I digress. All right, so that's at the money. All right, so everybody's with me. All right, so let's delete this and let's see what it looks like. So we've got bid, we've got ask. Now what's this? This is cool. I told you I wanted you to sell a 30 delta put, which means it's got a 30% probability of being in the money. See, right now it's out of the money. Remember how I drew it? It's out of the money. So I want to go down to a 30% probability being out of the money. So here's 29, here's 29, here's 30, here's 30. So either one of these would be fine. So if I want to sell an option, I would be selling an option at the 403 strike of an asset that's currently at 431. So I am how many points out of the money, y'all? If I'm selling the 403 and the current price is 430.
27-ish.
I'm 27 points out of the money. SPY would have to move 27 points for me to be in the money. So what's this? So I'm going to sell the 403. What's this little wristcraft? So mash your left button. Now, watch this, y'all. Here's why I'm a quantitative trader and investor. What is my probability of profit? 75%. Hey, how cool is that? How does it know? Well, I would say that if I'm selling something that has a 30% probability of being in the money, it has a 70% probability of being out of the money. Now, when we do the Black Shoals option pricing model, and we'll touch on that, but it's not really something that's going to bear in. All of these brokerages use the Black Shoals option pricing model to come up with these models. They may have little tweaks on them, but it tells you that your probability of making 1 cent at expiration is 75%. This option has extrinsic value. I don't want to talk about that much today, but it has value equal to what you're selling it for, $880. Extrinsic means out of the money value. Don't worry about that. We'll talk about that more. But here's the really cool thing. What's this, y'all? So you've got a 75% chance of making money, but you've got an 84, 85, 86, 87% probability of making 50%. Now, somebody tell me, without looking, well, you can look, what is the maximum profit that I'm going to get from selling this option?
882.
Yeah, $882. So there is a 85% probability that you're going to make $441. Do all of a sudden you kind of see how selling a put puts the odds in your favor rather than just buying the stock? If you buy a stock, you've got a 50-50 shot of it going up. If you sell a put, you've got a 75% of that thing remaining out of the money, and you have an 87% chance that you'll be able to close this booger, buy it back, and make $441. I like these odds more than I like 50. Now, ladies and gentlemen, what you are developing in this class, and you may not yet know it, is knowledge and wisdom that will be powerful tools for you going forward. Because whether you're a poker player, whether you're a gambler, whether you're a trader, whether you're an investor, if I can put the odds in my favor, then that's what we need to do. We won't put the odds in my favor. For example, last night, Beth and I were watching Joe Millionaire. Y'all watching, anyone watching Joe Millionaire? Am I the only one? We love those shows. So they got all these gals in a mansion, and then they press out these two guys. Oh, and they got the swabby hair, and they got the cool little beards, and they're fit and all this kind of stuff. And so one of the guys is a multi-millionaire, and the other guy's just, you know, poor as dirt. But they don't tell the old gals which one is which. So it's really, really interesting, right? So, you know, we're watching it and all this kind of stuff. And why I watch these shows, I am smitten with 90 Day Fiance. Y'all, I could watch it all day. When I get out of here, if I'm not going to watch The Young and the Restless when I finish with y'all, I'm going to be in there watching old episodes of 90 Day Fiance. I love those shows. I don't know why, but it makes me feel better about my life. So we're watching it yesterday, and you know, they're got these two guys out there with their muscles and stuff, and they're trying to impress the ladies, you know, and they're cutting wood with their shirt off. And I'm like, please. I'm like, these ladies, they're so gullible. And then I look over at my wife and I said, I'll tell you what, honey, you want Big Daddy to go out there today and take my shirt off and split some wood? I'll do it. I'll be eye candy for you for a day. Guess what Beth said? Oh, hell no. You ain't doing nothing like that. Hey, I was ready to go out there and find some wood, take my shirt off. That's like, no, I'm fine. She's good. So what was I saying that? I said that for some reason. So, odds in our favor. So, you know, back when Beth and I were dating, I would take her shopping all the time. We'd go shopping and to the mall. We'd have a great time. And the whole time I was miserable being in the mall, but I was, you know, I guess I was happy because Beth was with me. So after we got married, and we've been married for 22 years, you know, every now and then she'll go, I remember when you used to like to go shopping with me. I said, Beth, I never liked that. I said, I was trying to trick you into marrying me. That's what I was doing. I was putting the odds in my favor, woman. You didn't see the real Bobby come out till, you know, after we're married. And then, no, I don't want to go to the mall anymore. So what you and I have to do in so many of our life situations and decisions is put the odds in our favor. Now, I'll show you this and I'll let you go. I want you to see this. All right, so let's go to the little graph so you can see this. Oh, this is so cool. What's this? Here's the analysis of a put. Y'all. This is power. This is knowledge. Now, remember, the break even on your stock, where was your break even point at? Right where you bought it, right? Your break even was if it goes up a penny, you make a penny. If it goes down a penny, you lose a penny. So if you had bought shares of SPY at 430, you immediately lose a penny if it goes down. But watch this. Hold my yoo-hoo. If this thing expires and it doesn't go down below your break-even price, right? So your break-even is, let's see, normally I thought it said my break-even over here. Let's see, theta, delta, probability, exchange rate, break-even, SPY. Where's my break-even? I thought it put break-even here. Anyway, your break-even is right here. You see it, the 394.65, right? 394 is your break-even. So you would have lost a penny if your stock had gone down here. But for the next, how many days we've got, 50 days, as long as the price of SPY stays above the 394 here, you get to keep $876. You don't start losing until what? The price goes below your break even. So people will tell you that options are more risky than stock. That is not the case. If you sell an option and you sell a put, look, here's your break even on stock. If you buy it at 430, it's 429.99 is where you lose money. 430.01 is where you lose money. Look at what you've done. You have reduced your basis. You have reduced your cost basis if you get put the shares. Now, this is a powerful, powerful tool if you were going to buy 100 shares anyway at 430. Why would you ever do that when you can sell a 403 put with a break even of $394 and bring in $898. And now you know something that most people who graduate with MBAs and masters in finance do not know. And it's really powerful. Any questions at all? I've given you a lot today. I've drawn a lot of arrows. I've talked about me with my shirt off out splitting wood.
So let's say that you do all this, what are the tax consequences? Like this, the money that you make would just be ordinary income, right? There's no capital gain or anything like that involved. It's just treated as ordinary.
If you're doing a put that is under 12 months, you are absolutely correct, Kyle. But y'all, there's always a loophole. There's always a way to keep those evil, fat, capitalistic pigs from paying all these taxes. And it's something called a 1256 contract. 1256 referring to the code of the Internal Revenue Code that says certain options and certain underlines that we trade get favorable tax benefits at 60% long-term capital gains rate, while only 40% are taxed at ordinary income. And how long do you have to hold them to get the preferential rate? You ready for this? 1 second. You wonder why the rich stay rich and the poor stay poor? Because they don't teach this stuff to people. And it's so sad. And that's why I love being able to share with people, hey, there are ways that you can make money, that you can put the odds in your favor. And there are ways that you can do it that are beneficial to you and tax advantages. Now, you don't get 1256 treatment on SPY. I'm sorry, you don't. You don't get 1256 treatment on SPY. But I'm going to show you the things that you do get 1256 treatment on. So there's always a way. There's always a way. So, you know, people say, oh man, I don't want to do this because I can't make money. Trust me, the rich will always be rich. Jesus said, hey, I won't be with y'all much longer. He said, but the poor are always going to be around. And he was absolutely positively right. Jesus kicked it out of the ballpark when he said, you know what? You will always have the poor around. It doesn't matter if you think you're in a socialist nirvana, if you're in a communist country. It doesn't matter if you have a worldwide, what do they call it now? A world basic living income for everybody on the planet. The poor will always be around. There's nothing you can do to alleviate it. Now, what I try to do is to alleviate as much as possible by giving people knowledge and wisdom and power, right? Because we want people to be able to pull themselves out of it. So while we'll always have them around, there will always be instruments and derivatives and items that the rich are aware of. And if they're not aware of, they've got some big dude at a hedge fund that tells them all this stuff. So I'm going to share the beans with you. We're going to see the good, the bad, and the ugly. We're going to give you knowledge. We're going to give you power to go into the markets, knock the dinosaur on the head, and drag its dead, bloody carcass back to the cave so that you can feed yourself and the family. Question.
I'm just being silly, but can you do my taxes later?
Girl, I got to get on mine. Oh, and I'm the one that can't say no, right? Everybody and their mama, they call me and you do my taxes. I'm like, oh, no, it's just horrible. So I do way more taxes than I should. But
I'm not really going to ask you to do it. It's just here in Texas, we have common property. So our laws are, messed up.
Now, the best place to move for those of you who want to be a real trader, right? The best place to go is Puerto Rico. They have great laws for traders. But here's what I like about trading and investing. So let's say you and I were doing real estate. Well, you got to go check those properties. You got to go show those properties. And if you have a property management company running for it, they don't care about your investments like you do. And then you have to pay them a fee. Here's what I like about this. Y'all, I can do this on the beach. I can do it anywhere that I have my mobile device and an internet connection. Trading on the beach, trading by the pool, trading in the bathroom, you know, at work, trading wherever you're at. It's all you need. This is really the biggest money I've ever made has been on the phone. You know, trading on.
Why do you pick a put with a 30% delta? Why not some other number? Why is it 30%?
Yeah. So I could move my put. Watch this. I could move my put upward, right? So if I move my put at the money, now I've only got a 61% probability of profit. I've got a 74% probability that I make money, and I still have a lower break even than just buying stock, right? So let's say that you don't care if you buy SPY at 430, you think it's perfectly priced, you're good, sell a 430 put, then you're going to bring in $1,640. And you're still going to have a 78%, you get 50% of that at least, and 61% that you're going to have profit. And instead of losing money when it goes down a penny, you're not going to lose money until it goes down to here. But I've decreased my probability of profit. Now, just the opposite. Here's what Karen did. Karen went way down here. Karen went way down here. And she was picking up, as they say, pennies in front of a steamroller. For those of y'all that have watched the Karen the Super Trader video. So, you know, she goes down here and you go, hey man, this is where I need to be. So I'm going to come way down here and I've got a 99.5% probability of making money if I sell it down here. I'm still going to bring in $146. But have you ever heard this expression? The juice isn't worth the squeeze. The juice isn't worth the squeeze. Where I'm telling you, most of the time, you're going to be most comfortable selling a put at about a 30 delta, which means 30% probability of being in the money, or a 16 delta, 16% probability of being in the money. Why is that? Well, trust me, you see this little thing here? Everybody sees this, right? This is a what? Y'all know what this is, the little thing here.
The bell curve.
Bell curve. It's a normal distribution curve, and it shows you the normal distribution. So you've got one standard deviation away. I think that's the one standard deviation away, and then you've got 2 standard deviations away. So Karen was selling things at about 95%, so about 2 standard deviations. This is about where she was, you know, selling things. You know, and it's about that 1 standard deviation down move, right? So 68%, let me write it there. 68% of the time, the price of SPY is going to fall in a 1 standard deviation move. 68% of the time, the price in 50 days is going to go between these two, 68% of the time. We don't know which way. We just, the normal distribution curve tells us that's where it's going to be. So that leaves us with 16% probability that price will go above here and 16% probability that it'll go below 1 standard deviation. This is kind of the sweet spot, and we'll talk about it more, right? Getting just past, you know, or around that 1 standard deviation, half a standard deviation, gives you enough juice for the squeeze, for the risk that you're taking. Because if you go out here and you're collecting 5 cents or $5, you know, that's for a potential loss of, you know, $16,500 and you get $5. That's, you know, you got to look at risk reward. What's the risk to the reward that you're taking? So we're trying to get you to go out to about a 30, in between a 30, 16, 25 delta put that gives you, you're looking for about, you know, a 70%, 67 to 70% probability of success. That's what we're looking at. That's where you want the odds stacked in. You don't want a 99% probability of success, because guess what? that 1% time that you do lose and it goes past your strike down there, it's painful. And you only got $1 to prove for it. So you'd have to do that ton. So we want you to get enough juice for the squeeze. I'm excited for y'all. I'm just so excited for y'all. I think this is awesome that you guys are coming in on this and getting this. And I hope you don't ding me too bad and say, he didn't teach me how to pass the CFP. I'm just, honest to God, I'm trying to teach you how to make money. I'm trying to have you to make decisions that put odds in your favor. That's all that life is about. I knew that I had a better chance of getting Beth to date me and marry me if I never took my shirt off. Got to increase the odds. All right, any other questions at all? All righty. I will see y'all. Oh, y'all got a question? Sorry.
I have a couple, but you don't have to record it. I just had a couple things about understanding puts and calls because this is new to me. I've been doing investing for a long time, but never in options.
Sure.
If I understand it correctly, and please tell me that I'm not. So the price today we're looking at, and I'm just going to make these numbers up there. It looks like it's $440 roughly. So when you're selling a put, it's giving us the option to buy the stock at that $371, correct? Not the...
No. So that's a great question. It's the option buyers that get the options. Okay. So in other words, if I buy an option, I have the option to do something, but I do not have to do it. If you are the seller of the option, you are required to do something. So when you're selling a put, you're basically providing the insurance to someone else who wants to buy the option. So if at expiration, the price of the stock is below your strike price, you are required to be put in the stock. I mean, it's going to be put to you.
But you got it on sale.
But you got it on sale.
So you hope that it goes up. So you have a max profit on those when you're selling a put, you have a max profit. It doesn't matter what the market goes up to, your profit's capped, correct?
Correct. And this is going to sound counterintuitive, Brad, but by capping your profit, you're increasing your probability of profit.
When they're talking about going up, the stock price going up, it's anything above your strike price, or is it above what you, so right now it's at 440. If I'm selling a put, are we hoping it stays above the 300 and I can't see it under there, 71 that's on your put? Or are we hoping that it stays above the 440?
Yeah, wherever your put is, you want it to stay above your put. Yeah.
So is there a correlation then, or is there something if like you put it down there for Karen, you scooted it down? Obviously there's less profit, most likely because you're taking less risk, and the odds are that it's not going to drop that far down, correct?
Yeah, so what Karen did is she was moving out to about a 5 delta. So she was about what, 2.5 standard deviations away from the center of the normal distribution curve. So she was literally going at a 5% probability of being in the money. So she had a 95 or greater % probability of success on every trade that she took. But believe it or not, these probabilities come into play. And if you're doing that, there is going to be 5% of the time that you're going to get hit, and that hit could be massive.
I think that's one of my areas of confusion too. I don't know if anybody else is feeling that way. When you say probability and then in the money to me is meaning I make money. How are those related?
Okay, so when I'm saying delta, that's a probability of being out of the money. See how it says ITM? So let's say that you had sold the 446 2 weeks ago. Your put is now in the money, which means the current price of the asset has gone below your strike price. Now watch what I move it over here. Now I'm out of the money. Now I'm in the money. Now I'm out of the money. You want your put to expire out of the money. You want the price, and it's represented by this little flag. You see it's going up, now it's going down. It's going up, it's going down. It's going up, it's going down. By expiration, you want your price to be above your strike price so that you get to keep that entire amount that you put in. Now, we're going to talk about managing these. You rarely take an option to expiration. I rarely ever take something to expiration. I mean, again, that's building on the knowledge that we currently have. But we'll talk about that. You know, you're going to have questions. Trust me, it took me a long time to go, oh my gosh, I'll never get this. You know, how in the world will I ever get this? I've got a bachelor's in finance. I got all this stuff. They didn't teach me this. How do you learn this stuff? So we've got people in academia who don't know this crowd. That's what kills me. And anybody can teach from textbook.
Agreed. Last but not least, sorry, I don't mean to take up all the time, everybody. So if you have something real quick, jump in. I was wondering on the Thinkorswim platform, if there would be a sheet or something where we know how to use the software. That's where I'm running into problems. Like you said today, you know, tell me how it's doing. I always refer to paralysis by analysis. I've got so many little gadgets and widgets open right now in it that my screen looks way different than yours. I don't even know what I'm looking at. I'm just confused on what I'm looking at.
So here's my plan for next time. Next time when we get together, I'm going to share my screens with you guys so that you can now go into Thinkorswim and you'll be able to open my setup. So you've got everything set up that I've already got set up without you having to get all those little bells and whistles.
Can I ask a suggestion also? I was thinking about what Brad was saying too. What really helped me when I first started working in mutual funds and brokerage a long time ago was when we were in the nest, they would give us screenshots of the systems we were looking at and like circle or highlight the tabs or the bullets that were the most important. And that gave us an opportunity to write a side note to ourselves and say, oh, this is what this means. This is what this means on the screen. Because I agree with Brad, sometimes when we're looking at so many different things at the same time, it doesn't make sense anymore.
And hopefully that's what we did. Remember the time when I brought out the thing and we said, I did the little where I wrote on the order confirmation screen, max profit, max that. So something similar to that, right? That
yes,
will show you
yes.
And
yeah, something that's tangible that we can go, okay, here's my little cheat sheet. Okay, that's what that means.
Yeah, we can do that. And I'm telling you guys, this is the most difficult software that you'll ever encounter, but it has such bells and whistles. I mean, you'll get, I promise, after a while, you can get so comfortable doing this on your phone with the mobile device that it's going to be second nature to you. Now, keep in mind, I'm going to teach you a lot of stuff. I want you to have every tool available to you after we finish our investments class, but then we're going to use it to put in a simple strategy. So we're not, you think, oh my God, I'll never be able to put in a strategy. So whereas most people engage the market and go, hey, I'm just going to do this today. Why am I doing that? I don't know. We're going to develop a plan, a systematic strategy for you to go in and to obtain money out in the market. And for your strategy, it may not even involve options, but I just want you to know what they are. I cannot believe I've taken all of the investments classes I have at all of the universities I've ever taken, and nobody told me anything about how to sell or buy a put. I can't believe that. And I'm not going to let y'all get out of here without y'all knowing all this stuff.
Well, it's 2 paragraphs in every textbook. That's all it is. That's all the deeper they get into it.
Because the people that write the textbook probably Googled what an option is. Hell,
I worked in investments 10 years at 2 different big companies. They never taught us. We never knew anything about it. That was for the fund management team, and nobody else needed to know. That was their philosophy.
So when
you just hit it right on the head, Lisa.
So when you get out and you want to pass the CFP exam, that's fine. You're going to have enough knowledge in here. You're going to know a lot of stuff, but you're going to take a cram course anyway. Every one of you are going to take a cram course. I want you to know how to make money. I want you to be able to one day sit by the pool, manage your investments, raise some goats and some chickens, get you a dog, and enjoy your life. You don't have to stand by this and watch this all day. Who wants to do that? Do something, put the odds in your favor, and go. Open it up once a month. Open it up, once a quarter. Put your stuff on, get your business together, and be done with it. I don't want you sitting in front of your screen all day. That's no life for y'all. I don't want y'all to have that life. I've tried it. I've tried to be a day trader. I'm a horrible day trader. Sitting here watching all these, things all day, and these candles and all this garbage. You don't want that. What, Beth? Oh. So that's not the life that I think most of y'all want. What do you want to do? You want to retire early. You want to go on vacations. You want to spend time with your family. You want to spend time with your kids, and you want to do it before you're old and decrepit and, got to be put in the old folks. That's what we all want. It's really kind of simple. So we'll show you how to do it, put the odds in your favor, and over time, you will be an asset accumulator, and you'll be able to retire early and to be able to spend time with your family and do all the stuff that you want to do. That's the dream.
Dr. Gaines,
Is
it's
this-
Lisa. It's
Hi,
Lisa
Lisa.
Benton.
Hey,
Hi.
Lisa.
I wanted to ask you about the Discord app
Yeah.
that you have. What's the best way to engage? I downloaded it what's the best way to engage with you on that app or to participate or?
Yeah, we have live chat in there, put a question in there. You're welcome to do that. Some of y'all are emailing me and stuff. That's good too.
Okay.
You can text me. Some people are texting me. Some people call me, Now, the thing is, you've got to keep in mind, I got a zoo at my house. I got goats, chickens, and all the crap, and the kids are worse than the animals. So it may be loud in the background or whatever, but I really do try to keep up with all the stuff. And I do one-on-ones with people, setting their camps up, getting all that stuff. So, but yeah, and there's other traders within my Discord room who are really there to help. It's really good. You may not know this, but traders, and there are traders and they're investors. I'm an addict. So the only reason I'm a trader is because Beth made me stop playing poker, right? So I'm a trader and investor, but I'm addicted to it. I love this. So most traders, on the pits of the floor, they're not really there anymore, but most traders are a-holes. They really are. And they're going to treat you like an idiot. And they're going to say, well, if you want to learn, you need to, you need to apprentice under somebody. And they're just hateful. God, they're hateful. All these forums online, they're just the most hateful, arrogant SOBs you've ever seen in your life. I created a community where there are no SOBs. Well, there's a few SOBs, but we've kind of grandfathered them in, right? And if anybody's in there and being ugly to anybody, I kick them out. Because it is a place of learning. There's a place to help you to develop the skills to dump the dinosaur on the head and drag its bloody carcass back to the cave. And you can feel free to ask other people in there and to get their opinion. And if I see them saying something wrong, I'll correct them. But most of the people who respond are very knowledgeable people. They've been doing this longer than I have.
Okay, last thing. I think Brad had asked a question regarding the market order that you said never to do. Can you show that on the Thinkorswim?
Let's say, yeah. So if I go to trade, right, and I'm going to sell this put, then you can change the order from limit to, well, thank God it won't let me change it. It won't even let me do a market order. It doesn't look like.
Okay, so it would be right there.
Yeah. By default, and by everything that I give you is the default. And again, I never do a market order, so I'm not even sure I know how to change it into a market order. But if you ever see something to where you can change something to a market order, never do that, because you are at the whim of the market makers.
Right.
Hey, whatever the price is, and if all of a sudden it just shoots up, well, that's where you're going to get filled. If it shoots down. And remember, our first day together, what did I tell you? The market is here for one reason, to take your money. Somebody is here to take your money. And we're not going to let them. And one of the tools is we use limit orders. So I will penny this thing up nickel by nickel till I get filled, because I'm not going to let someone take advantage of me with the marketing. So yeah, limit is you set the price. If my price is not hit, I don't get filled. So if I'm willing to go up and say, well, okay, give me a 725 credit, right? But you reduce it. So instead of me getting $7 in credit, I'll accept $6.75. And then you might have to move it a little bit more. You know, I may accept $6.50. But y'all are asking all the right questions. And listen, I don't want you to ever say there's a dumb question or not question. There's not. I promise y'all. I know where you're at. I know where you're at in your life. I know where you're at. I know what you. I think I know what you want. I know a lot of you want to take the CFP exam. There's probably 3 of you in the whole class will ever take that exam. I'm for the rest of y'all who you're going to be taking care of your mama, your daddy, your mama, your papa, and you're like, how do we manage this money? And so you don't have to hand your money over to some Yahoo that's going to charge you fees that you don't need to pay. When all of this stuff is as simple as can be, they want you to think it's complicated. It's not complicated. Now I'm showing you some complicated stuff, but you wait. When we start developing our plan, your investment thesis, your investment plan, we're going to simplify it. And the more you simplify it, the more successful you're going to be. You remember hearing Karen. Karen said, you know, I was doing all of this. I was doing stocks, 30 stocks, 50 stocks. She said, the more I simplified it, the more success that I have. And you're going to find that as well. Keep it simple. Keep it simple. Great question. Anything else? All right. Roll Tide, and I will see y'all next week.